So what I was thinking is that, the main thing that you're interested in are those spreadsheets. Craig, did I have it right that there are two of them?
Yeah. I have many, but those two I've gussied up to where they have a front end. They have basically a control panel that allows anyone to use it. And they both focus on retirement income. So modeling retirement portfolio survival. And the key thing, I guess, to realize is that Monte Carlo is a pretty well established approach to estimate or to model retirement portfolio survival. And I have nothing against Monte Carlo when it's used logically. The challenge with Monte Carlo, though, having said all that, the user has to enter a expected return and an expected level of volatility. And so it's very dependent on the inputs. So, and not everybody maybe knows what a reasonable standard deviation level is. I mean, I have my students interview people they know, and generally speaking, people that are not very versed in investing or portfolio design, they sort of assume and tell my students that the expected return is around 10%. So somehow people just kind of get that. They have no idea about standard deviation, none. And so Monte Carlo is
much less correlation coefficients.
Yeah. I mean, that starts to remind them of their stats class in college, and they start to get a little woozy. And that's not a criticism. It's just that, when you swim in this stuff, you think that everybody swims in it, and they don't, and they shouldn't. I mean, I'm not normal, and I've got to get out of the house more often.
We've also said that. We've noted that. I've not done it.
I know. Mindy has told me many times. I've got to get help. So my spreadsheets rely upon historical performance. Pete, I'm just kind of rambling here. Let me just show you. Can I grab the screen?
I'm going to give you control here. Yeah. Good.
Okay.
And Craig, while you're doing that, I appreciate all your time, and I want you to, just to know that the philosophy that you have so nicely documented is really something that we've embraced here with using these exchange traded funds in a diversified portfolio, and trying to keep the costs as low as possible.
Mm-hmm.
And I'm using the Schwab platform here, so I've gone through myself and sort of picked out the funds that fill up each one of your recommended baskets in your 12 asset portfolio, and most of those I can buy on the Schwab platform with no transaction cost. And like the large cap one has a 3 basis point expense ratio, as you probably already know.
What's the average?
Yeah, that's great.
What's the average internal cost total, by the way?
It's probably slightly around 12. I would, just going off the top of my head, probably about 12. Some of the the emerging market one is a little bit higher.
What's interesting is, especially in light of the discussion that Craig had last week with the difference between indexes, I got a feeling that it's not that important, that those differences, but that's one consideration. But what does Craig have that we can uncork for you?
Yeah, no, I like when you demonstrated those spreadsheets. I thought I really want to have those because, like you were saying, Craig, we've got plenty of software, and it does lots of really cool things, but ultimately people seem to gravitate toward one or two pieces of paper, and it's always this spreadsheet looking thing that has, what's the historical performance, what's the projection.
Oh my gosh, Craig, you actually have those tickers then for Schwab ETFs.
Yeah. So are you seeing my screen?
Yeah, now I see what you're. So Pete, were you aware of that? Did you know that?
Yeah.
Okay. I didn't realize that you had those already.
Well, but Pete's doing the logical thing, which is, I mean, a lot of people want me to pick the ETFs for them, and so they buy my reports. But once the model is laid out, right here, I mean, Pete, we both know it doesn't take a rocket scientist, to look at this recipe and say, oh, okay, I can go to Fidelity, I can go to Schwab, I can find the tickers that go in those boxes, and that's what Pete's doing, which makes perfect sense.
Right.
Yep. So,
and I think a lot of advisors do that. They like the recipe. See, I think this image, that the multicolored boxes, my impression in talking with advisors is that this image is quite helpful.
He uses that. That is the image he used when he showed me what he did. I have a question about this. Why, if he's not using the 712 brand?
Yeah, he is. He's using the 712. I mean, he's built a model that follows the 712 recipe.
But he's not using that with clients. You're not telling clients it's the 712 model, are you?
I'm not saying that most of the time. And if I have on occasion said, here's Craig Israelsen's name, here's a website, here's a book, for people that are really interested, I encourage them to know all that they want to know about everything that I'm doing.
Yeah.
And
that's perfect.
So I'm not coming in here saying it's 712 is our, model that we're using. I'm saying I'm using this philosophy where we have a diversified portfolio, and I do use one of your slides as an example that has the superior diversification with the colored boxes, and then I sort of write in, SCHX where it says large U.S. stock. That's SCHX is a Schwab large cap fund, and we go from there. And really, I'm trying to set up a base set of holdings, and I'm not trying to get a ton of holdings, but I'm more comfortable if somebody says, hey, I want to buy or whatever stock. I'm fine doing that after we have our base portfolio in place. We can go and branch out and do some different things.
Yeah, that's great. I mean, that's super logical to me, that 712 really is a philosophy, and it gets very granular. As you can see on your screen, I've got active 712 model, I've got a passive ETF model, 3 Vanguard models, as you can see, Fidelity model, and then here's the Schwab ETF model. So Pete, here's the historical returns back to 98 of the Schwab model, and the expense ratio with the tickers that I've selected is about 21 bips aggregate for the Schwab model. Performance, the active model over the last 21 years, 7.2. I'll just highlight it here. So Schwab is 6.7, Fidelity is 706, the Vanguard ETF is 698. Point being, the 21-year returns are pretty similar across the board, and that's why it makes sense to talk about the 712 model as a philosophy. How it's implemented is actually secondary. In other words, if you build the Schwab versus, say, a passive ETF approach using several different providers, over the last 21 years, the differential is 9 basis points in performance. So the recipe drives the result, not necessarily where you buy the ingredients for the recipe. And that's what Pete already understands. I think a lot of people understand that. So where where I factor in is for people, advisors, or individual investors. They say, I just want to use the tickers that Israelsen has selected and call it good, and that's fine. And that works for a lot of people. Others want to see the recipe, then say, I got it, and then they move forward. It's a big ocean. I mean, there's room for everybody on how they want to do it. In more specifically, I think what Pete's asking is, what else do I have now that he's built the model that might support the model? Here's basically, if you can see this, my screen, which is it's a big graph, looks like a Monte Carlo graph. This is the retirement portfolio survival analysis spreadsheet. So what it allows, everything in yellow is something that you enter. That's user controlled. So the starting balance of the retirement portfolio, the advisor fee and or expense ratio, aggregate expense ratio of the portfolio. So if you combine both, let's say it's 120 bips. So that accounts for the cost of the ingredients, the funds, and the advisory fee. So whatever that is, there's several different scenarios. If I put one in this box, that's a fixed withdrawal that now appears over here. So this would be for accounts that are not governed by RMD. And if you want to stipulate a 5% initial withdrawal rate and a 3% COLA, that's where you do it. If I enter 2 in this box, now the withdrawal rate initially stays the same, but now the COLA goes to a CPI-based COLA. So, behind this front end is all the CPI data. And so now the escalation of the withdrawal is based on actual CPI. If I type 3 in this box, now this is RMD based. So this is for most, I say most, I think my hunch is for most people, a lot of their retirement income is tied up in accounts that is governed by the RMD. And so this is where I spend a lot of my time as I use this spreadsheet in my own research. And then 4 is kind of a weird one. That's the higher. So this, in mode 4, out of the portfolio will be taken the whatever amount of money would be, whatever withdrawal is largest, that's what will be taken out. So if it's based on, if the RMD is the largest amount taken out, that's what will be taken out. If it's a fixed rate amount that was stipulated with a fixed COLA, that's what will be taken out. If it's a fixed start with a CPI COLA, that's what will be taken out. So I don't know how useful that is. I guess I was just in the midst of programming. I just thought I'd toss that in. So the value of this one, and then the portfolio allocations down here. And so I only have 7 asset classes that have historical data back to 1970. And that's the time frame here, 70 through 2018. So what this model is doing, what the spreadsheet is doing, is looking at all the rolling 25-year periods between 1970 and 2018, because we have to take into account people retire in different years. They have a different first year of retirement. And those sequence of returns during the first 5 to 8 years of retirement really have a huge impact. So if I just page down, here's the 25-year rolling returns right here, and all the results. And the results in a table like this are really granular, but that's a lot of stuff to look at. And so the same information is conveyed up in the graph. So the value, let's go to an RMD based. The value of this sort of spreadsheet is number one, if a client says, okay, I've got $1 million, how long will it be until I run out? And the conversation goes probably something like this. Well, if you only take out the required minimum, which if you start with $1 million, the average annual withdrawal over each 25-year period was about 137,000. Okay, that's the average annual amount withdrawn. And so that gives them a ballpark right there of kind of their budget. Obviously, it's the amount taken out differs year by year. So this average of 137 is sort of an average of an average, but it gives people a ballpark. The average amount taken out over the entire 25-year period, and there were 25-year periods, was 3.5 million right here. The average ending balance was 2.1 million. The maximum ending balance 25 years later was 4.1 million. The minimum was 742,000. So what this really, I just showed this to my class last night, actually. My belief is that a lot of people, when they enter retirement, they look at their balance, they see that balance as doing nothing but going down. Because in their mind, it's a barrel of water, and they're going to be taking money out of the barrel. And how could it possibly go up in value? Well, the reality is it's still invested. Now, right down here is where we have the allocations. This is the portfolio design. That's a fairly aggressive design. That's about a 70% equity, or what I call engines, and 30% breaks. And so let's say that that's too aggressive for somebody, and so they want to go 8%, 8%, 8, 8, 8, and then say 40% in bonds and 18%, call it 20% in cash. Now we're fully allocated. So now this is a 60%. This is a 40-60, 40% engines, 60% brakes. So if that's about what a person can live with, the average internal rate of return was 8.7%. And they say, okay, I can live with that. And here's all the allocations that show up live in the graph. What we now know is that over these 25 rolling 25-year periods, the average ending balance was 1.6 million. And that's what I think really changes people's view of the future. The success rate was 100%. You never ran out of money if you only took out the RMD, the stipulated minimum. Now, if you take out more than that, then things will change, and you can sort of simulate that by going to option 4. And if you say there's a 6% withdrawal rate, well, then now our success rate went down to 64%. Go back to 5%, now we're at 100%. Oh, so right there, that's what we call sensitivity analysis. Between 5 and 6% is kind of a breaking point, at least as we have all the variables set up right now. And so the way that, I use this to do research, but I think an advisor or an individual, and I've sold this to both individuals and advisors, they're trying to get a picture of the future, just to kind of look through the haze a little bit, look through the mist. And to me, one of the most powerful, I'm going to go back to RMD, one of the most powerful realizations is that it's really hard to kill a portfolio if you're reasonable in your withdrawals. It's really hard. Now, if you go to all cash, let's look at all cash. Here's the person that says, I can't stand any volatility. Okay, well, obviously, all of the bar charts, all of the graphs, they really consolidate because there's so little variance in the returns. The average withdrawal each year was about 63,000. The average ending balance was just under 600,000. Point being, the portfolio doesn't die. because RMD doesn't allow that. You can't kill a portfolio if you're only taking out the minimum. Well, what if it's not RMD? Let's go to option 1. This is a 5% withdrawal, 3% COLA. Okay, now we killed it. A little bit less than half the time. We had a 56% success rate. Well, this is going to probably tell the person, this is a Roth IRA. Somehow they got $1 million into it, which is a real trick.
Hey, Craig. On that, when you do that 5% withdrawal as a starting point and a 3% COLA, does that make the withdrawal it would be $50,000 the first year, but then would it be 50,000 times 1.03 the next year?
Yep, exactly. Yep, you're right.
51,500. Is that how that works?
Yeah. Yep. Okay. Yeah.
It's not it's not the 5% of the ending balance of the.
Correct.
Okay.
Yep. Yeah, that's why this initial withdrawal methodology is so dramatically different than the RMD, because the RMD, as you know, it takes a percentage of the portfolio's balance at the end of the previous year.
Yep.
And so after a year like 08, so in 09, most people's RMDs were lower because their portfolio went down. Whereas this approach we're looking at right now, if you stipulate an initial withdrawal rate and you stipulate a COLA, that sets in motion a series of withdrawals that can never go down, in the strictest sense.
Right.
And so that's why RMD and this approach are so different. RMD has a built-in safety mechanism, that only takes out a certain percentage of the portfolio. And if a portfolio had hammered, then it takes out less. So anyway, in this kind of picture that a person's seen, it becomes clear that, a 5% withdrawal rate is a little bit too aggressive. They either have to reduce the withdrawal rate to say 4. Oh, okay, that was good. Then now our success rate's 80%. But now our annual withdrawal up here is about 60,000. Not enough. So what they're probably going to be led to is that they're going to have to be a little bit more, I would say, reasonable in their portfolio allocation, and then get a few engines in there. So if we give them a 5% allocation to the engines, we go 40% in bonds, and we go, say, 40% in cash or 35% in cash. Now, that's not an aggressive portfolio. It's 25% to engines, 75% to brakes. Our success rate goes to 100%. Our average ending balance goes to 2.6 million. We just scroll down, we took out an average of 1.5 million over each 25-year period. And that's right here, also on the graph. To me, this sort of approach, it can be sort of mind-numbing if we don't explain what we're looking at. But once a person becomes familiar with what they're looking at, to me, the huge takeaway is, wow, you mean I don't have to live in fear every day of my life as a retiree that I'm just going to totally blow through my portfolio? Is that what you're telling me? And as me, I'd say, yeah, you don't have to live in that kind of fear. If you're reasonable in your withdrawals, if you're reasonable in your allocations, it's really hard to kill a portfolio. And to me, that's a quality of life. This is sort of a quality of life experience. We're not promising anything. We're just saying, historically, with these variables that we're all comfortable with now, there's no period historically where this approach ran out of money. And there's all kinds of different market cycles embedded over the last 49 years. So that's probably enough on that, but that gives you an idea of what the at least what I think the spreadsheet is designed to help people see.
So real quick on here, what is, oh, I see. You're using a 7 on this portfolio that's 75% conservative, we'll say. What's, is there somewhere on here where it says what the rate of return?
So the average rolling return was 6.97%, and the average 25-year internal rate of return was 7.4. Just two different ways to try to get at the same thing. In other words, the rolling return assumes, it's a lump sum investment, whereas the IRR takes into account money being taken out. And then over the entire 49-year period, the return was 6.27. And here's the year-to-year returns in this bar chart. Those are the annual returns of that exact portfolio, which is right here.
Okay, and where is there a tab on here that says what the year-to-year distribution is?
Yep. So we go back up and we scroll. Whoops, sorry. We scroll to the right, and now these are the annual withdrawal paths. And because we set in motion once we stipulate the initial withdrawal rate and the COLA, that means the annual withdrawal over each 25-year period will be the same. So this graph is really boring, but we see it right here. So we start off, our first withdrawal was $41,200. Our maximum withdrawal, which would have been the last year, was $83,751, and the average withdrawal was $60,085. Things get interesting when you choose something like RMD, and now that really changes, right? Because the RMD now is much more sensitive to the portfolio's fluctuating values. So the first year's withdrawal in every rolling 25-year period was in the red, $36,496. The maximum withdrawal really varies by which 25-year period you're looking at. And then the average withdrawal is in the middle here. There's one more graph that...
So where's the year-by-year one on that? Was there if your first one was 36,000, what was, hypothetically, what's the second year?
Okay, so here's each year right here. So each year in the 25-year period. So year one, let me go up to the top here. So the bar graphs indicate the average ending account balance at the end of each year in the 25-year period. But we got to remember there are 25 rolling 25-year periods. So to show all the first-year withdrawals, there would be 25 of them. It gets really complicated because there's so much data.
Yep. No,
so
I understand.
Okay. So the blue is the average ending balance. The little green dot is the maximum ending balance. The pink is the minimum ending balance. So this gives you a sense of, okay, with an RMD, at the end of year 2, my average ending balance was, I'll just hover over, 1.1 million. And then at the end of year 3, and there's 25 year 3s. Here's my averages. And then you've got one more piece of information over here, which puts this graph into kind of a tabular format. And so it gives you your average ending balance at the end of each year, remembering that there's 25 year 1s, 25 year 2s, and so forth.
So is there one that says average RMD for each year? Or did we already do that?
That would be, yeah, that would be this one here. There's a couple ways to see it. So this is now we're in RMD mode right here.
Yeah.
So my average annual withdrawal over each 25-year period was 95,000. The actual withdrawal in year one, that's where we'd have to go over to this one here. And then that's the aggregation of all the year ones. And let's see, that's my account balance. So you're asking about the actual RMD amount. And that would be, no, that's the 25-year total. This is the ending account balance. So it would be, that's not really it either. That's the first year. That's the minimum, which is the first year. It actually would be this graph here, but that gets a little bit tight because this is the annual withdrawal paths. So right there, they're all there. It's just they're all so scrunched together.
So when you go to year two, what does that show you though on that series? Yeah. So series two, yeah, that's.
Yeah, the average, you can just hover over it, and your average was 36. Yeah. Well, that's not quite. I mean, yeah, what you're asking for, I'm going to have to think through how to show that without it just kind of blowing up the.
Well, I think you could say what's the. Well, I don't know. You take the balance on year one divided by 27.4, and the average balance on year two divided by whatever the year two thing is. You probably have it in here someplace.
Yeah, the trick is just, I mean, the graph you're looking at right now, this is the annual withdrawal over all 25 rolling 25-year periods, and it starts to diverge. In other words, the amount of withdrawal doesn't change that much during, say, the first 10 years. Once we're out about 20 years, it can be as high as 189. It can be as low as 72,000.
Right.
Because by then we have some accumulated momentum of differential sequence of returns. So when you hover over it here, you're seeing roughly about 41,000 was the RMD withdrawal, the average RMD withdrawal in the second year. I'll have to think through that and see if there's a way to show that. It might have to be as a table.
Yep.
Just because the graphs start to get really messy.
Yep.
We've got the first year withdrawal here and the last year withdrawal here in this table, but the year to year to year, I've actually thought through that before. It just explodes in how big the table has to be. So you have the first and the last, but it's the intermediate years, and here's the average annual withdrawal.
Yeah, there you go. That's what I'm saying.
Yeah. So that, that may help a little bit.
So why would the average annual withdrawal go down on the RMD when the denominator
performance? Yeah, over this, so 1970, well, for example, the sweet spot, let's go up to, let's equally weight it.
I'm going to mute you because that's, when I mute us, then we don't get an echo. So that's why I was muting you, Pete.
Okay. So in this, if we equally allocate across all 7 asset classes, so now it's kind of a growth-oriented portfolio. What's really interesting is to see the sweet spot, which is right here, 1975 to 1999, because we missed the 73, 74, U.S. equity meltdown, and we finished. So 75 was a good starting point. We got the kind of the crash of the early 70s behind us. 99 means we ended the analysis before the tech bubble burst, and our ending account balance was 4.15 million. And here's all 25 ending account balances, and it's really really dependent on the returns of that 25-year period. And
Okay, I got you.
have the.
Yep, I'm with you. I was thinking that on this average annual withdrawal, that was year 1, year 2, year 3, but that's just that 25-year period. So I'm with you.
That's a 20. Yep. You're right. Yeah. So the last 25 years, from 94 to 2018, have been that's the worst. That's the worst 25-year period since 1970. And part of that's just really low cash returns and bad commodity returns. But even if let's go to 100% just to large U.S. stock, and now it's just an S&P analysis. Still, the last 25 years, if we look at the ending account balance and the average withdrawal, even if we just focused on large cap U.S. stock, the last 25 years have been pretty rough. When you look at all of the rolling 25s, 1975 to 1999, the ending balance was 10 million. Whereas the most recent 25 years, the ending balance was 1.4 million. That's just a world of difference. The average, let me blow it up here a little bit. The average withdrawal was 272,000 in that 1975 to 99 period versus 101,000. So this is why sequence of returns is so dramatic. We can really show it, in a table like this, that when you step off the bus into retirement, you hope that you have a good starting sequence of returns, and that's why it makes sense, to maybe kind of buffer the portfolio during the first 5 years of retirement, and then if they make it through the first 5 years, without a major hit to the portfolio, then you can in fact you can maybe raise the aggressiveness a little bit. That TIAA has been pushing that idea for some years, that a portfolio's asset allocation may even get a little bit more aggressive as you progress into retirement. Yeah, and Pete, please feel free to email. I'll be back in about an hour, and I can respond to any questions you might have.
Keep me in the loop, guys, because I like being a fly on the wall for this, because, like I said, I think we could try to use this productively.
Appreciate all your time, Craig. Really wonderful stuff, and it's made a big difference to how I run my business. So thank you very much.
Oh, you're welcome. I appreciate meeting you, and hope we have more conversations.
Okay. Thank you both.